What's up, everybody? This is Sunko, the Korean bro. Today is 2023. When is it? June, July, August, September, October 23rd, right? Okay, let's start reading an article. Okay. The three safest Warren Buffett stocks to buy and hold for the next 20 years. Three reasons to buy Nikola Corporation stock and three reasons to sell. Okay. Mitsubishi Markel Group, Berkshire Hathaway, Mercado Libre, Zometry Academy Sports. Okay. Elon Musk shocks Tesla stock investor. Okay. Okay. Two stocks split stocks that could plunge up to 89% according to select Wall Street analysts. Okay. During periods of heightened uncertainty on Wall Street, it's not uncommon for investors to seek safety in profitable, time-tested, outperforming business. While defending stocks have been somewhat of a mainstay for investors over the past decade, it's companies enacting splits that have been garnering plenty of attention over the past 2 years. A stock split allows publicly traded company to alter both its share price and outstanding share count without affecting its market cap or operating performance. Think of it as a purely cosmetic change that can either make a company's shares more nominally affordable for retail investors or increase the company's share price to ensure it meets the minimum listing standards of a major stock exchange. Tesla implied downside of 89%. The stock split stock that offers jaw-dropping downside, at least in the eyes of GLJ Research's Gordon Johnson, is electric vehicle maker Tesla. Johnson, a longtime Tesla bear, has a split adjusted price target on the world's largest automaker by market cap of $24.33. If this price target were to come to fruition, it would represent an 89% decline from where Tesla stock closed on October 19. Although Tesla is North America's leading EV manufacturer and the company looks to be working on its fourth consecutive year of profitability, some no other EV pure play has come close to achieving. There are a number of potential warning signs for current and prospective shareholders. To begin with, Tesla kickstarted a price war earlier this year that's proving disastrous to its margins. The company's four production models have endured more than a half dozen price cuts, according to CEO Elon Musk. Tesla's pricing strategy is entirely driven by demand. Multiple price cuts signal that inventory levels are rising and demand for EV remains tepid. Unsurprisingly, Tesla's operating margin has plunged from a 17.2% to 7.6% over the past year. As I've said in the past, leadership is not a reason to be cautious with Tesla. Despite being a visionary, Musk has also proved to be significant liability for his company. He's drawn the unwanted attention of securities regulators on a number of occasions, has made countless promises that simply haven't been fulfilled. For instance, Musk's pledge of level 5 autonomy coming next year is something we've heard for the past decade. Furthermore, Tesla has struggled to become more than a car company. Energy generation and storage revenue has practically flatlined over the past couple of quarters, while SolarCity has been a money loser since it was acquired in 2016. This is a big problem for a company with price earnings ratio of nearly 70. Based on Wall Street's consensus earnings in 2023, by comparison, most auto stocks have P/E ratio between 5 and 10. There's no question Tesla has broken down barriers in the auto space and used its first mover advantages to the fullest. But with competition picking up and the company's operating margin plunging, down is the likely direction Tesla stock is headed. Fever and Roku. Okay, Roku. The media streaming market is a global growth story. Roku was therefore chapter one as a streaming hardware division of Netflix. When the company started delivering movies online as a free add on to the DVD mailer service, spun off as a separate business in 2009, the company never stopped developing and refining its streaming content experience. Though the business has largely moved from a Roku branded set-top boxes to software licenses for smart TV makers. This leading platform expert dominates the North American market already and is now expanding its reach on a global scale. The target market is expected to quadruple in size over the next 7 years. And I expect digital advertising to hit a stride over the next couple of years, recovering completely from the inflation driven downturn of 2022 and 2023. The lack of ad-based sales in recent quarter has driven Roku's stock price 82% lower in 2 years. Lack of ad-based sales in recent quarters, okay? That struggling sector is still stealing market share from a traditional ad channel such as TV, radio, and billboards. In the long run, the vast majority of its sales should move to the highly targeted online advertising segment, and Roku is carving out a significant stake in that sector. So Roku is chasing a large and growing target market, expanding its market share on a global scale, and leading the charge of cost-effective marketing services. The company added 10.4 million active accounts over the past 4 quarters, and the top-line sales increased by 11% in the recently reported third quarter. Yeah, you can grab shares at the beyond reasonable valuation of 2.6 times sales. Lightfield Roku's business is a push for a dramatic comeback as the global economy gets back on its feet. The stock shouldn't be far behind. Okay, let's go read Amazon.com. Amazon. Amazon is incorporating artificial intelligence into every aspect of its operations. Okay, let's see. Amazon and Alphabet look positioned for long-term success in the emerging artificial intelligence opportunity. Analysts at Bloomberg Intelligence expect the generative artificial intelligence market to grow at a compound annual rate of 42% of 1.3 trillion dollars by 2032 as more companies get involved. E-commerce giant Amazon and online search leader Alphabet are industry frontloaders as they incorporate the technology into their consumer-facing platforms and cloud computing segments. Let's explore what these new revenue streams could mean for long-term investors. Amazon starting as an online bookstore before becoming a diversified e-commerce giant that earns most of its profit from the cloud computing. Amazon has a long track record of reinventing itself by pivoting to new opportunities. From the looks of it, generative AI will be no exception. Uh, as the company incorporates the technology into many aspects of its operations. According to business leader, Amazon has launched a secretive initiative called Project Now, designed to overhaul item discover its e-commerce marketplace. Project Now, okay. When implemented, the new features could allow for product comparisons, personalized recommendations, and even a conversational shopping assistant designed to help customers find their perfect item. The end goal is to boost Amazon's conversion rate, encouraging people who browse the site to make purchases. But Amazon's e-commerce ambitions are not limited to just e-commerce. You know, in September, the company announced a $4 billion investment and strategy partnership with ChatGPT rival Anthropic, which specializes in creating a foundation of models. AI algorithm trained on a vast amount of data that can be adapted to a wide range of tasks. The deal will give Amazon a minority stake in the business, while Anthropic will use Amazon's cloud computing platform, AWS, for its data and computational needs. Over the long term, investors should expect AI to be a significant growth driver for Amazon, boosting the performance of both its e commerce and cloud computing business. Amazon has a vast exposure to artificial intelligence. The company has huge optionality on AI. At the same time, Amazon stock is not expensive. The tech giant is set to outperform in the AI revolution. One of the biggest trends in recent years is the proliferation of artificial intelligence, creating new opportunities for cyber investors to ride for the next few years. But not all opportunities are created equal, and the casualties of AI companies will be high. Thus, investors should be cautious with their investment choice in this area, focusing solely on companies best positioned to win in the long run. This article will explore one company well positioned to leverage AI wave to greater heights. Amazon. Amazon has vast exposure to AI. You know, it's a company that needs little introduction as its e-commerce business is well established in the US and globally, but not many know that tech companies are a significant user of AI technology and a provider of AI product services. Let's start with e-commerce. Amazon relies heavily on AI to improve its efficiency and customer experiences. For example, Amazon uses AI to provide personalized recommendations to users, which will help improve user satisfaction and retention. Besides, the e-commerce company uses AI in almost every aspect of its operations, including warehouse operations and logistics. With the help of AI, Amazon can do more work with fewer resources, and the benefits flow directly into its top and bottom lines. Hmm. While the impact of AI on Amazon's e-commerce business is indirect, AI's influence on Amazon's cloud computing business is direct and far-reaching. Okay, I'm gonna have to put stop here because I need to go to toilet. I'll come right back. Okay.